News, the #1 independent cannabis investing show, where we break down complex cannabis markets into clear insights you can actually use. Here are your hosts, Jesse Redmond and Morgan Paxia.
Welcome back, guys. Welcome back indeed. I am Jesse Redmond, Chief Strategy and Investor Relations Officer. Oh my goodness. And we're having a replay of the intro. Whew, let's restart. Welcome back indeed. I'm Jesse Redmond, Chief Strategy and Investor Relations Officer at Leaf Brands. I'm back today with one of the smartest cannabis investors I know. He's the grizzled veteran, Morgan Paxia. Morgan, good afternoon. How are you?
Good afternoon. I'm doing great. Another day of historic activity in this burgeoning space. How are you?
I'm good. I feel a little bit feels a little bit chaotic. I feel a little bit unprepared. I've tried to have this new morning routine, Morgan, where I get up, I wait on having coffee, and first thing I do is read in the morning. And I've been doing this every morning this year, reading at least 10 pages, 5 books deep. Keeps me away from social media in the morning, makes me a more calm human being. This morning, I made the mistake of checking my messages and woke up to 13 text messages about rescheduling. And that has put me in what they call fight or flight mode, where your sympathetic system is activated all day. So that was more information than you wanted.
One of those, I probably texted you at what, like 5:30 this morning?
Yep. No, I appreciate you sharing the news. But yeah, man, I'm stoked. I'm doing well. We'll get into it, but we didn't get everything we wanted yet. But we're getting started, so I feel good about that. And Morgan, let's welcome back one of our favorite guests. He is Sam Armenia in real life, VP of Corporate Development at C21 Investments. He's Sammy J on X. Sammy, how are you today?
I'm doing amazing. Thanks, guys, for having me back. It's awesome. Turned 50 since the last time I saw you both. So that's, on a personal level, that's an accomplishment. But I think today's news is I agree with you. I'm having trouble keeping up today with the messages and the calls and what does this mean for the sector, for the stocks, for the businesses, so we're all in a bit of a fight or flight right now, trying to, digest this.
Yeah, well, and kind of classic higher exchange structure today, where it's just a few guys having a conversation, trying to figure things out. And even the most informed people that I've talked to today, everyone's kind of connecting the dots on this. So excited to have a conversation about it. But Morgan, before we get into the heart of the show, do you want to give us some 420 updates and tell me about some awesome dispensary software?
Sure. Well, first, congrats on the 50, Sammy. You're looking great.
Thank you. Thank you.
50 is the new 40, so you're doing a good job with that. So, a quick shout out to FlowHub, the all-in-one platform built for cannabis dispensaries, point of sale, inventory, compliance, e-com. They do it all. 420 isn't a day anymore. It's a season, and the weekend before outperformed the holiday itself by 70%. So this is data coming straight from FlowHub. Operators who plan for that, they won, and FlowHub helps you get there. So there's a ton more statistics. I thought that was really interesting. I think they also said the Monday was a 3.3x over a typical Monday. So certainly, there's a lot more data to parse through, but 420 is come and gone once again and continues to do its job, and good software will help you get through that day as smoothly as you can.
Yeah, I loved all the data they put together. I caught Kyle a little bit on the Dales report, and then they shared some of the data that you mentioned, Morgan. Other things I thought were interesting is that promos dominate, which is no surprise. People go out on 420 because they want discounts. So 82% of transactions were discounted. Average discount was 37.5%, which is a record. So almost 40% off is the new average. Loyalty versus acquisition is interesting. As a former dispensary owner, you're always trying to find ways to get more new customers. And on 420, 85% were returning, only 15% new. And new markets, Morgan and Sam, had the biggest baskets. South Dakota average order value was $132 with 7 items in the cart. So just a few more things to add on there. How did your stores do there, Sam?
Great as always. It's always the biggest day of the year, with lineups and whatnot. But it's a bit of a, I don't want to say it's a gimmicky, holiday at this point, given where we're at, but it always feels like, why are we doing such heavy discounting just to get the same customers through the doors, on a single day? Like, it only hurts the bottom line for all these operators, right? You're blowing out, margin just to keep up with the Joneses, essentially, right? So because we saw with Ethos, I don't know if you guys saw that Forbes article with Ethos, right? They closed their stores in their 3 states to kind of counter protest the holiday stuff. Yeah. So and I get why, conceptually, why do your biggest day of sales at low margin?
Yeah, totally get that. I used to low key hate 420 when I was an operator because you sell through all your great stuff at a discount. The week before is super slow. The week after is super slow.
Yep.
You just cram 2 weeks of business into 3 or 4 days at a highly discounted rate. So I love 420 for a community. I think it's important to have a holiday. It raises visibility, but from an operator's perspective, it was never my favorite.
It gives all our favorite politicians an excuse to go on X and pretend they care.
Right.
Well, it is just it's a celebration, right? And so, it is pretty cool that our industry has a dedicated holiday. What other industries have that? I heard Emily and Cy talking about that on the High Rise, and Daniel Davis on our YouTube chatting, rebranding it as a customer appreciation day. And I think that's a really, good way of putting it, because as you mentioned, Jesse, it's like 85% of it was just returning customers. So it's really just a chance to reward your high value customers, and so
that's a good way to do it. I like that idea. That's a good way to rebrand it for sure. So was there any other news today, guys? Are we
no, I think we're just going to talk about 420 and basket sizes was what I thought we'd lean into. Yeah, let's not bury the lead, folks. We've got a few things to talk about today. We want to talk about rescheduling. We want to talk about Vireo. We want to hit GTI, get a couple updates from Sammy. So much to get through. People get very mad if we chit chat too much up front. They get very angry. They'll be in the comments saying it's 8 minutes in, you haven't asked a question. Yeah. So, man, we got to get cruising here. So let's hit the big one first, guys, which is the news around rescheduling. And we're talking backstage, and we said we're all working day jobs here, but trying to connect the dots in our free time and have a conversation today. So I took a shortcut and I reached out to our good friend Hirsch Jane and had a quick conversation with him this morning. And he was kind enough to share some of his thoughts, and I thought he did a real nice summary of it. So thanks for this, Hirsch. And I think I'll just kick it off, guys, by setting the table, reading my perspective on things, and then would love to hear high level. I'll start off with you, Sammy, and then weave over to you, Morgan, on it. So first of all, medical cannabis is Schedule 3 for now, not fully final yet. Legal challenges are to be expected. 280 relief is on the way for medical, which is an immediate benefit for the state licensed medical operators. I thought the AG's tweet was written very poorly in terms of using the word state licensed and not using the word medical in that tweet. Agreed. So I found that confusing. Buried in this, DEA plus exports longer term, there's an opportunity there to talk about fast track registration, but there's some issues there in terms of EU GMP being a potential bottleneck. So more conversations about that to come down the road. Adult use, guys, still Schedule 1, no 280E relief yet. Hearing runs June 29th to July 15th. So a little time ahead to try and work through this on the adult use side. 2-phase process, medical done first, adult use decision likely follows post-hearing. I think I've seen Boris and Kim both comment that they expect adult use to be finalized in Q3.
Correct, yeah.
And backdated tax relief is possible, but not guaranteed. Treasury is still deciding how to treat prior years. And man, how huge is this for some of the operators out there? I think most, if not all of us, have been accruing some sort of a UTP, and we're some are staring at some multiple hundreds of millions of dollars balances. So how that gets treated over this year is critical. Getting this done this year is critical, especially on the AU side, but also looking at the past few years. If we could get some relief there, that would be massive for the industry. So, my friend Sammy, why don't I start with you? Kind of high level, what's your read and reaction on the news?
I think the market is missing the point here. I think this is the biggest news the industry's ever had, because it's no longer a question of when anymore. When came today. Now, the bifurcated obviously wasn't on it. Well, I mean, I've seen it speculated over the years, but I don't think any of us were expecting that today. And so you can understand why there's a bit of uncertainty and a bit of scare in the market, but I think it's critical to not overreact to what you're seeing in the market. I haven't even seen where we're at, but I'm assuming it's double digits on everybody decline right now, which it is, for the most part, except for Trulieve. And you say, well, the market's all that matters, or people say the market's all that matters, that market's reaction to news is what matters. We don't have an efficient market, guys. We do not have. I've been saying this for years on X. Anybody that follows me, we do not have an incremental buyer. It's this is about fast money flows in and out, and that triggers algo selling. There's a very predatory algo on these names, and as soon as it sees the selling, it's amplifying that. So the idea that the market is saying that this sector is worth X because this is the reaction, it's all nonsense. Don't give it any credence. We will not see price discovery and the true value of these companies, good or bad. Let's not assume that everybody is worth more, because that's not the case. But we're not gonna reach that point until we have custody and uplisting. One side caveat that I think is important to bring in is that we saw JP Morgan buying Trulieve and GTI on Tuesday and Wednesday, about 5 million notional in Canada through the CSE for the first time since they ruled that they were no longer allowed to hold U.S. Custody or hold U.S. cannabis stocks in November 2021. So, and I run every back test I can to see if there's been a single purchase through JPM on anybody, and there hasn't been until Tuesday. So some people are saying, well, it's JP Morgan Canada, but there's a difference between rules and kind of policy, right? And bottom line is subsidiaries tend to follow the policies of the parent org, and any U.S. federally registered bank has the policy that they cannot trade in these CSE OTC stocks. Cura and TerraSend being the exclusions from that because they were uplisted to the TSX, and we do see institutional investing in them. I looked on Tuesday just to see what was going on with Curaleaf, to see if JP Morgan was there, and Morgan Stanley was the number one net buyer of Curaleaf on Tuesday. So they already, if you look at just returns or performance over the last year, Curaleaf is by far and large the outsized performer in the basket, let's call it. And you can probably draw a line from their TSX listing to that. Taking into account obviously that they have Europe and they have other reasons for having the highest valuation in the sector. Currently the highest sales in the sector. I think access is a huge component to this. And it's 3-to-1, right? I mean, I think the average is up 100-ish%, 120%, something like that. Take out today because I can't keep up with all these swings in the market. But Curaleaf, as of yesterday, was up 320% from its 52-week low. So that kind of significant outperformance is pointing to access and custody.
And Sam, just real quick before I lose the thought, where are those JPM shares ending up? Like, who's the actual buyer there? Like, what part of the bank? Like, where's the demand?
the likely scenario there is just a client, right? It could be a high net worth, it could be a fund, but the fact that someone gave approval, whether it's a waiver, whether there's been an internal policy shift, we don't know yet. I've reached out, haven't got an answer yet. But the fact is something changed, right? Because you don't go from 5 years of not a single print to 2 days in a row, 5 million notional. Like something shifted, and whether or not a fund or a client got approval and got a waiver, or there's been an actual policy shift due to the news that dropped yesterday. Was there a bit of a front run on that? Some have speculated, with the Axios dropping the news yesterday and obviously being confirmed this morning. So, we'll see. I looked quickly before I jumped on with you guys. They're not in the market today. That could be explained by the fact that nobody really understands what this means for these companies exactly yet. And until that's clarified, there's going to be a bit of uncertainty in the market. And I think that's just what we're seeing in the stocks, right? All it takes is for whoever was buying to stop buying, and for a few people to get scared and, trigger algo selling. And, don't forget, these companies all ran 20 to 30% yesterday. So there's no backfill of a bid on any of these names in 24 hours, right? So the second they're selling, it's a free fall. It's not like, there was some stability in these markets going into today. So
yeah,
it's the volatility creates this kind of, whipping action that we're seeing in the markets. But ultimately, I think, to go to the more important point, I think the market is misunderstanding what today means. We can dissect whether or not this is more beneficial for a Trulieve who's 85% medical versus other companies that have taken on more of an adult use, revenue base over time. But let's not forget, all of these companies, all the multi-state operators, single state operators, we all began as medical operators, right? I mean, Silver State Relief, shout out. We were the first licensed medical operator in Nevada, July 2015. Then adult use passed, a few years later. A couple of years ago, the Nevada program merged the two licenses. So there's now one dual purpose license in Nevada for both medical and rec. I'm seeing some speculation already from some of the CEOs. I had some conversations today that the state programs can essentially just repurpose themselves and call themselves medical as of ASAP to kind of capture the Schedule 3 classification that dropped today. How we see that all play remains to be seen.
Because they all started as medical, everyone still has medical. It's just
Correct.
Been a dwindling market share within those states that have adult use as well. But I would just suspect, if we don't get through this expedited hearing and adult use is clarified, medical will just naturally grow because the price differential will be so significant that people will just say it's worth it to get a medical card again.
That's right.
And be able to capture that. So one way or another, it's, having at least a part of this clarified. I know this is still, creates uncertainty, and so people are responding accordingly. Because we only got medical, and it, as Jesse mentioned, it can still potentially be contested, and there is this possibility, but it is not confirmed, about 280E retroactive. Still helps going forward. So it still has. Naturally, there's a lot of questions around it. I've been certainly getting a lot of questions all day about it. But I just think
we're stopping the clock. We're stopping the clock on accruals as well, which is, I mean, the erosion of value of these companies due to the accrual of UTP, right? Like it's massive just to stop the clock. The fact that the administrator has recommended to the Treasury that they take a backdated approach on medical here. We don't know if it's going to be 3 years. Some are suggesting it go all the way back to the beginning. We'll see how. I'm sure we're going to get some guidance from the Treasury soon. But I think it's important to see. I was flipping through the 33-page order, and one of the points is that as long as you are a licensed operator that's in good standing, the DEA must grant you federal status of medical. So all of us are essentially going to become grandfathered federally legal medical operators. What that should do is that should open up banking, and that should open up credit cards. So there's a huge potential organic lift here just from that alone. But until we have clarity and certainty on all of this, and how do we operators that are running both, do we start to from today forward, do we start to segment our business?
Yeah.
Right? Do we try to run a 2-track system here?
Right.
So,
and well, it just could be the reverse of the last few years where medical just starts consuming adult use just because of, for what we're talking about. But just to push back on the idea that it doesn't change the federal legality being Schedule 3. So why do you think credit cards and banking would naturally just become okay?
Because you're a federally registered medical operator with the DEA. The DEA is going to grant federal licenses with a nominal fee to
Is it an actual license, or you're just registering?
Let's see if I can find it in the 33 pages while we talk.
Yeah, no, because that's a big distinction.
A
license, I understand, has a perceived more legitimacy versus just, hey, you're going to put your information in here and you're going to abide by this construct, but it is not because a license to me would mean that there's federal regulation involved, but it doesn't sound like there's regulation involved. It's just more that they want to know who is in this program. And I understand that because they want to create more of a bright line between who's legal and state licensed versus who's not.
State authorized medical marijuana certifications or similar documents are sufficient to permit the dispensing of medical marijuana to users. So that's not answering the question, but I'm going to find it because I know I saw it.
Well, he's doing some digging there, Morgan. Let me just kind of take a step back with you. What was your high level reaction? And I'll be a bit leading here, which is a bad interview style. But backstage when we were talking, I saw you making some more mixed faces when Sammy had more optimistic takes. So I want you to be your honest self, Morgan.
Yeah. Well, first and foremost, rescheduling, even if it's a partial step, is incredibly fantastic, right? But for me, it's until we get actual resolution on what does this mean for the taxes, what does this mean for adult use. I feel like the helpful thing is we have a timeline potentially to come to more resolution, but for the meantime, I'm not. We were talking about this internally. It's like I'm not at all surprised that the market, it ran up and then it just came back down. It's like, how many more times have we seen this until there's like concrete, actual clarity? This is just what happens. Like, it doesn't at all make me surprised or upset, or I'm just like, what else would you expect? I mean, this is how it is. And
it's federal it's federal registration, guys.
Yeah. Okay.
Federal DEA registration for manufacturers, distributors, and dispensers.
Right. So it's just putting your name in a federal database.
Yeah.
So, which I know years ago people used to be really worried about getting medical cards because then your name's on some registration or on some registry. So, but that's gone away. So yeah, no, I mean, I guess I'm just unfazed with this kind of stuff. I mean, it's like,
dead inside, some would say.
Dead inside for sure. I mean, because, what matters most is what's actually going on within these companies. And I know, like, we can talk all day long about the broken construct of not having custody and not having exchanges.
Yeah.
But I'm still of the belief that if these companies were growing at double digits and generating healthy profits, their stocks would trade very differently regardless. I know day to day, sure, there's plenty of noise with algos and all that stuff. But, over the last
do you mean that specifically for the tier ones, or do you mean that for any and every company? Because I could argue that we showed double-digit organic growth year over year in our T31s, right? Trailing 12, double-digit growth, organic growth. We bought back 2.4 million shares. We have less shares out than all-time highs, and we paid off 30 million senior debt. This company, my company has generated far more value than where we were historically, and yet we are at our lows or near our lows. So what is the market telling us? Is it that C21 doesn't have this ability to sustain this as a future? Or is the market just completely disconnected from reality?
Well, I would also ask, where was it trading before, and why was it trading there before? Was that justifiable before, when it was at its all-time highs?
All good questions.
Markets go,
But does so one of our questions is, right, is GTI fully valued, right?
Like, where are you trading on, like, a EBITDA, which I hate EBITDA, but just because it's what everyone quotes.
I don't want to do EBITDA. Please don't do it.
Yeah.
Please don't do it. We don't. Yeah, I mean, our EBITDA and our adjusted EBITDA are the same number. So it's a bad comparison across the space.
Oh, I know. I know, but that's what everybody quotes.
The bigger question is, should U.S. cannabis stocks, on average, be trading at 1x sales and 5x EBITDA? Is that the right valuation? It may have been with 280 accruals.
Yeah, and the clear answer there, guys, is right. It depends, right? Like, at a high level, when I think about this in terms of where we go from here, is we need a framework and a set of rules that serious investors can understand.
Yeah.
And was the space investable with 280E? In most cases, 90-some%, the answer is no.
Correct.
So if you're new capital coming to space that's not super deeply involved, doesn't have huge opinions about politics, you're seeing these huge UTPs, you're seeing the accruals continue, and you're looking at businesses with an unsustainable tax structure. And so I think back to a conversation I had with a small cap growth manager in 2024, and he said, Jesse, how can I play the game if I don't know the rules?
Yeah.
And I think that's a really fair point. And so let's correlate that to where we are now today. You want to play the game, and now you've got this set of rules, right?
Yeah.
You're like, Jesus Christ, I didn't know what was going on before. And now you expect me to understand what's going on here, the medical now, maybe the adult use later. And so
you have two operators on this chat here, right? And a fund that's been in the space since day one. And I don't think any of the three of us know what this entirely means, right?
Well, I think that we know it's a positive step forward, right?
Yeah.
Like, it's a step towards clarity. And I think we're starting to get these steps more often, and they get to be more meaningful. And so if we're sitting here in Q3 and we check back in with you, Sammy, and adult use gets done and we're on that path, then I think we look back and we say, okay, this was a super painful stage process, but it's getting us to where we want to be with a set of rules that are palatable. But at this point, if you're looking to commit millions of dollars on the institutional level, you're either just speculating about what's going to happen and saying, I'm confident S3 gets done, or you're just going to wait and say, hey guys, I'll do a little bit of work, but call me when this is finished.
Yeah.
And so, like, one of the things we were going to talk about is, does this bring in fresh capital? And my answer is probably marginally from retail groups or the same investors buying more. But I think it's going to take real clarity to actually get some of the bigger money to come in.
110%. Yeah.
Yeah. So this right now is like, this is the period which will probably bring in more to do work, right? To refresh their work on it, so that they are ready when rules change, if they want to participate, right? I mean, it comes back to the opportunity cost of capital, and where else are they deploying capital, and is this better opportunity than where else they're investing?
Mm-hmm.
And I think that's right, that we and that's why I say, like, until there's more clarity, we're making progress now. This was a big deal. This was huge, right? Even the partial step is still a big deal, but there's just more questions that these institutional groups are going to want answers to, and it's and that will come in time. And nicely, we can say, like, there is actually a timeline we can point to, is June 29th to July 15th, no later, assuming that holds, and see what happens with the tax treatment. I mean, if it really happens where we do get retroactive relief, then I totally agree, Sammy. Like, this market is completely wrong, because that is a windfall that substantial, especially if you already haven't taken your refunds. If you can now get refunds, like, that could shore up a lot of balance sheets in a material way overnight. I mean, as quickly as they can do it, but
or for a GTI that's already sitting on 275 million of cash, and they just started accruing their UTP in end of 24, so I think they're somewhere around 120 million. I'm guessing they didn't itemize that in their 10K, unfortunately. But how quickly
They could pay off it
does?
all. They could pay off all their debt.
But what if they get a few $100 million back?
That's what I mean. They could pay off all. I mean, they have plenty of options. I mean, that's the nice thing about their situation of not accruing such a massive liability relative to their peers. It's a windfall for them. And
I mean,
maybe why
they can already pay it off with the cash they're sitting on. But I mean, you throw a few $100 million at them, solve their senior debt, buy some roll-ups, and have some spare change in your back pocket. I mean, it's a substantial. And then I still think we can't quantify, but as we normalize, right? Medical has been, as of today, normalized. We're going to all assume that this is final rule, this is done, and medical is now a Schedule 3 drug, and that starts a normalizing process in I think the public conscience, right? Where you start to see more and more incremental users of cannabis as this becomes normalized. And then if we can get some sort of banking credit card scenario down the road, I think that unlocks a lot of value as well. That is really not, again, none of us can underwrite this process because we don't know what, to your point about your previous conversation, we don't know what the rules are yet.
Do you think credit cards are a bigger deal than exchanges?
No. For the stocks, no. For the companies, yes.
Jesse, what do you think?
I think it depends on the shape of the companies, because I don't see uplisting as a magic bullet. I see it as a way to realize fair value through a bigger, more sophisticated investor base.
Yeah,
but I'm not saying this is cannabis. But if you put a turd on the Nasdaq, there's not a line out the door to buy it just because the turd went to the Nasdaq, right? But if you have a situation like what I'd love to see line up, guys, is we had a period where we had revenue growth, and that was awesome. We had a lot of interest in the sector. We had the year of the core, and we've had that for, is this our third year of the core, something like that, right?
Yeah.
I mean, Charlie said, I think it was maybe on this podcast or somewhere else, now every year is year of the core. Turned out he was actually right. And we're 3 years into year of the core, where operators have gotten leaner, even operators like Leaf. Like, I don't know if you've done the same thing, Sammy, but everyone's running.
I think we were the first to do it.
Yeah, so everyone's running leaner, more efficiently. We've seen it across the tier ones as well. So that's awesome. Now, what I'd like to see is take that leaner infrastructure, get federal reform, but you've got to bolt on the growth piece, guys. Like if this is not a growth industry, that line out the door simply does not form. Like, can you get some value unlock? Yes. Can you try to time politics? Yes. But cannabis has to be a growth story. It has to have double-digit growth to be attractive long-term. Flat, down, mid-single digits, that's not where we need to be.
No.
So the answer to the question about the higher exchanges, great podcast, is that higher exchanges, I think, will unlock some value for sure and be a big pop. But to be meaningful long term, it has to be paired with companies that have palatable balance sheets, lean operations, and have real growth. And I think we can do the balance sheet. Well, balance sheet is tricky, but we can get some balance sheet improvements. Operations, I think, are fairly lean, but we need to get, whether it's the hemp conversion, whether it's Virginia, whether it's PA, whether Florida finally flips, we've got to find a way to drive growth to get serious investor interest.
Could today be a bit of that, though, right? I mean, the clear bifurcation of state legal programs moving to Schedule 3 versus hemp, illicit, smoke shops, gas stations, everything else is still Schedule 1. Like, is this the government's attempt at basically saying those who've played by the rules for the last 10 to 20 years, that have paid their taxes, been regulated, tested, done things the right way, we are going to let you guys have the relief right now. And for everybody else, sorry, but we're going to start to crack down on that. Like, is this a signal for that? And how much, we've had, I don't know if we've had this conversation, but I've had this conversation a lot lately, which is how much of the 20+ billion hemp, intoxicating hemp market comes back if if November comes and it's, the loophole's closed. Does it all just go dark again? Is it just become a big illicit market again? Does 20% of it come back to state legal? That's a substantial growth story in itself. as is credit cards, as is. So, you can start to layer. But to your point about the more sustained growth, whether it be organic or inorganic, you start to wonder at what point, and there's a lot of chatter about this, right? The consolidation of this sector has already started. I think it's at varying paces depending on who the operator is, but Vireo is taking a very aggressive approach to this that I think we'll start to see maybe other tier ones start to pursue, which is, the roll up kind of tuck in, whether it's distressed, whether it's, just smart accretive add-ons to existing states that they have. I think that's where the sector's headed. And I know there's a lot of, especially with the retail audience, there's a lot of reaction or harsh reaction to, well, but it's dilution. Well, it's not dilution if it generates an accretive add to, the business on a revenue per share basis, on a, cash flow per share basis, on an EBITDA per share basis. And if you look at what they did with Proper Wholesome, Deep Roots, they shared us state level data in their year end, and they had organic same store sales growth that they generated in markets like Nevada, where there was significant double digit decline. So are they adding on accretive assets here and building value for the company, right? That's really the question that shareholders, I feel like, because we have mostly a retail base, they don't do that work, right? They're not looking at, well, this company generates 50 cents a share of revenue, and they bought X company and now they're generating 70 cents a share of revenue. Who cares that they diluted? They built value. Like, why is that conversation not happening in this space? Because
yeah, so let's transition a little bit here formally, because we're jumping into some of the names, which I think is good. But we wanted to dive into GTI and into Vireo strategy a little bit. So Morgan, why don't I pass the microphone keys over to you to talk a little bit about GTI, being mindful of the clock here. We're already 40 minutes in, which is fine because we're talking about super important stuff. But let's just kind of do a bit of a speed round between GTI and Vireo and talk about a couple of different approaches to what's going on right now.
Yeah. So these were thanks to the audience for submitting some questions.
Yeah, totally.
Saw those.
Yeah. So that was the genesis of some of these topics. But, people actually were asking what was the bear case for GTI. But I think it's imbalanced to just talk one side. So I want to talk about, the bull case, the bear case. It was interesting how you made some comments around how much Curaleaf has outperformed because, for the last several years, when you see like ATB does their annual survey, GTI tends to rank as like the kind of industry benchmark because of their balance sheet and how they've operated. But it has underperformed, right? So, is it, in your mind, like, is it actually, even though it's perceived as a high quality operator in the public space, is it fully valued? Is it undervalued? Like, where do they go from here? And, just some context of the last couple of days we saw, or just this morning, they further increased their stock buyback, presumably understanding this news is coming and they'd have more ability to do it.
Yeah.
They're now reinstituting conference calls, which happened shortly after the JP Morgan bids started showing up. So it's like, are they getting themselves back in the muscle memory of preparing for an uplisting, or is this just pressure because they want to start reaching out to the investor community again because more eyeballs are coming back on the space? Is there more upside here? Are we missing something about what they're not doing? Because they have not been nearly as accretive or acquisitive as Vireo's been on a rampage. They have not. GTI is not. So are they, and their business is done, again, relative to the cohort pretty well. Their top line numbers are generally above their competitive set, as is their operating income. Because to your point, like, I can't stand EBITDA because people don't pay taxes. So how do you really talk about EBITDA versus, on an apples basis?
Yeah.
So that's kind of, a little bit of level set, but, where do you kind of see the bull bear case on GTI?
The bull case, one of the first things that I think that differentiates them is they are probably the only national brand that's already kind of established itself, right? I don't know if you guys were following the tracker that you had sent out the link to, but Rhythm was tracking as the number one flower as long as I was watching it. the brand strength that they've built, and whether it's the partnerships with Barstool, or whether GTI products ending up at the Academy Awards in the loot bags, or like everything they seem to, Joe Rogan with his dog walkers on his desk, like everywhere you look, kind of GTI seems to have a national presence. Their partnerships with arenas and concert venues, and so I think they have a leg up there on the strength of their brands, and balance sheet strength is they're laps ahead of the field with their balance sheet strength. The fact that they haven't been acquisitive and have kind of sat back, to me, just speaks to the fact that they felt that they were undervalued and they'd rather, buy themselves than buy something else. And that's what we've seen them doing pretty aggressively, right? I think someone pointed out they bought like 5.5 million shares in March of their own stock. So that, that's what they're buying. Their messaging right now is that they think that they are a better buy than buying another company. And so that's what they've been doing. Do I see a bear case? I mean, cracks in margins, a bit of slippage on margins, but that's maturation of markets, right? That's everybody.
What about growth, Sammy?
Hey, at least they had it, right? They had 5%, and with their buybacks and stuff, they're generating increased revenue and operating income per share, and the metrics for them are a lot more favorable than everybody else for the most part. So, but to see that kind of sustained double-digit growth, they're going to either need massive material policy change to kind of open up the floodgates that we've been talking about up till now, or they're going to need to start to search out the accretive inorganic growth. And, we don't know if that's what they're working on. They could be working on that right now. We don't know until things get announced. But I suspect that we're going to start to see more tier one acquisition announcements, especially after today. I don't think they're all going to just sit there and say, I'm fine with my business as it is. They all want to attract institutional capital. Boris and Curaleaf, they have the steep growth curve of Europe to at least lean into, right? They've had significant double-digit growth in their Europe markets. They're going to be continuing to add with Turkey and Spain and France, and that's going to be $1 billion market for them over time. So Boris has said in a number of interviews recently that he's finally turned the corner domestically with his business, where he's starting to see some gains. We'll see how those numbers, pan out over time. But, for the most part, GTI has been standing still, if for lack of better, terminology. And that's not exciting, right? That's not exciting. And then, you drop off the earnings calls, and I get why, right? If there's no institutional investors and there's no analysts in the space, who are you talking to? Right? I mean, it's why we don't do it. We don't have an institutional following. We don't have an analyst covering us. Who are we going to talk to? So, I mean, Hedgeye just launched on us on Monday. Hedgeye went relaunch on cannabis on 420, and C21, GTI, Glasshouse, and Vireo were their 4 names that they profiled. They don't have price targets. They don't have your more traditional coverage, but those are the 4 names that they profiled. So, to their
let me pause on that conference call one for a second, Sammy, because I started the first call I ever did was with Leaf. I think it was 2 quarters ago, maybe. And it's not as simple as it seems. Like, just the script writing, the rehearsals. There's a lot that goes into having a good earnings call. But so I didn't appreciate how much work it was until I started from scratch and did it myself. So it's work. I understand that. It's a distraction to the core business in a certain way. I understand that. But he said, who are they talking to? The answer is they're talking to their investors. And whether they're institutional or they're retail, you're still talking to the people funding your business that own the shares. And so I get mixed emotions about this whole topic, because in the hedge fund industry, the way it matured was that initially there was so little transparency. Renaissance, Tudor, Caxton, Moore, Millennium, all those big funds sent you your statement. That was about it. You could hardly understand what was going on inside those black boxes. Yeah. And they do that as long as they can. When returns went down, industry got more normalized, competition increased. Guess what? They started communicating
They
more.
started talking.
Yeah, all of a sudden you could see what was going on in the models, how much was in StatArb, how much was in the US, how much was in Europe. Same thing is going to happen in our industry. The more demand there is from real investors, the more you need to turn over that data, the more you're going to see this kind of transparency. Look at Verano. Love what Aaron and the guys did over there, starting to share that state data. No one did it. And they're like, oh man, now all of a sudden everybody has this info on us to question. We put it all out there. Didn't make a real difference in the investor base because the institutions aren't here. So they decided to pull that back, which, you know, people that like to look into other people's business, we're like, oh, I want more of that. But if you're in their seat, I understand where they're coming from. So I get mixed feelings about the conference call thing, but I think it coming back is clearly a sign GTI believes more serious investors are coming to the space, and now it's worth the marginal time, cost, effort, everything to host that call because they're going to have real new investors show up. So as an advocate for retail and as a retail guy, you know, different parts of my life myself, I like those calls. I want to hear them. I think everybody should have access to equal information, but the operator side feels different. And I understand the motivation between like, I'll kind of do what I have to do in a way.
Yeah.
I wonder if
perfect succinct answer.
When you marked that performance delta, stock performance delta from Curaleaf and GTI, if you marked it from when GTI stopped doing the conference calls.
That'd be a really interesting, I can do that. I can put it up. I won't do it right now, but because we're running out of time, but
go ahead. We'll wait. Don't worry.
Yeah. Just real quick. No, just curious because to that exact point of like, if they stopped talking to their actual current holder base, if they just got disenchanted and just started, you know, selling out of their position and moving to ones that were talking to them and wanted, you know, to feel that kind of comfort, you know, and that willingness to share. So, but you know, now could be an interesting time because if they bring it back and then maybe that gap could completely close and surpass.
I mean, we all get it, right? We're all numb. You know, we all wake up and feel like we get punched in the face every day. So like, you know, there's that level of exhaustion that's, you know, has set in over the last couple of years in most operators. I mean, for the most part, I think, you know, everybody's gone quiet, right? You know, it's not like you see a lot of the CEOs or leaders or thought leaders in the space out there regularly kind of, you know, trying to rally the the investment community to say, no, we still got a story, right? Like, other than, you know, Jesse, you guys have a great story now, and so you've been trying to get out there, like, you know, but I'm always out there, right? I'm constantly doing these, but for us little guys, we don't matter, right? To the broader picture here. We need the leaders of the space to be the leaders, and for the most part, they've gone quiet. You know, I'm expecting that's going to change as of today. That we're going to see a lot more vocal leadership in the space moving forward now.
Yeah. So Morgan, you want to wrap it up and maybe talk about kind of bottom line if you think, you know, GTI is fully valued? Maybe, you know, do you see it as a buy? Do you see it as a buy here?
I see it as a buy. I mean, I do agree that you know, I think the idea that there's going to be more consolidation, you know, there's been so much in works this year already. I just think there's going to be a lot more of it. Massachusetts opening up the 5-store cap, you know, there's already a bunch of activity going on there.
Yep.
You know, and I just think, you know, this idea of organic versus inorganic, you got to make sure your core business is working, but supplementing it with more scale is just a natural progression for our space. And especially as we continue to work with pricing dynamics that we've been faced for many years now, more scale just helps you get those efficiencies. And so
that's 100%. I think the most important thing moving forward from today forward now is scale. And it's not obviously with the diseconomies of scale of the state silos and whatnot. It's not necessarily buying, you know, another tier one so that you increase your exposure across 10 states, but it's going deep in states where you can, you know, where you're not up against a cap, or where to Morgan's point about Massachusetts, you know, state like Nevada, there's no cap, so they can keep going deeper there. I think that's where you get the synergies, the efficiencies that that best deliver value for, you know, for the shareholder moving forward. And I think that's what we're going to see all the big guys doing. And I think Vireo's essentially doing that. That's what we're seeing Vireo. They've, you know, they're on a very aggressive track with it, and they whether or not they're going to create a bit of panic with the rest to kind of say, well, geez, they're buying everything. We better get going here. I mean, Boris kind of alluded to that on a TDR a month or so ago, where he said, we haven't been doing it, and everybody's kind of getting going, and I need to get going, and I'm going to get going right now. That's what he said. So,
yeah. Well, it's good. I mean, Jesse and I have debated, talked about this quite a bit. It's like how many deals will Vireo do before others will just have to get in the game? And I've had the fortunate, I've gotten to talk to John over at Vireo, and he is very clear, very mission driven. Like
100%.
He is like on it, and to your point about the fatigue is like a lot of these top tier MSOs, like they've just been so in their business trying to figure out what their core is, how to get to that core, that they have not been able to be as outward looking. I mean, they still have teams doing calls and like trying to be smart on the market, but the default mode has been, continue to work on the existing business.
Inwards, turn inwards instead of look outwards, for sure.
And John is like fresh energy, just like boom, just go.
Yeah. No,
but guys, do you have to do something? Is my question. Like everything's too strong. The vast majority of what's been done over the last 2 years, 3 years, 4 years, you would look back and say, wow, I wish I would have waited, right?
Yep.
Generally, things have been going lower. And so on the leaf side, we did an acquisition of a company called Himalaya in California. And so we're going to bring that in. We're going to get the verticality out of it, sell some of our oil through higher margins at dispensaries. That's the play. But at the same time, people come to us, and a bunch of people are showing us their companies now. We'd love to work with you guys. Love to be acquired by you guys. And we're looking at more deals, but we want to be mindful and make sure that we find the right ones and make sure we can handle the integration risk. And so when I look at Vireo, they've been aggressive. That's a perfect word. Active in 7 states, all across the supply chain, almost 50 stores, and continuing to move quickly. 317% revenue increase year over year from acquisitions. And I'm curious, as an operator and an investor like you, Morgan, I'll start with you, Sammy. Like, how do you think about that integration risk? At C21, you've got a limited amount of assets, and to bring in a new store, a new grow, a new brand, how much work that is. So at the rate Vireo's going, like it's the headline number of revenue is incredible, 317%. Some of the deals look pretty attractive, but if I'm honest, I would have said that a year or two ago and been wrong.
Been wrong, yeah.
Yeah, right. And so like I feel there's FOMO, as the kids say. You'll feel that, but generally speaking, you're better off waiting. So that's kind of one part of the equation. But the first one I wonder is like, how do you guys think about that integration risk?
Well, I mean, so all we can do is look at what they've done, because that's what we can see. I mean, Easy, Hawthorne, PharmaCann, Colorado, Schwazi. I'm missing one. I think there's 5 right now that they've announced that are in either stages of recently closing, but we don't have financial data on, right? But they gave us state level pro forma comparison from 25 to 24 with those 3 businesses that they consolidated, right? And it's, from what I read, it was a dramatic improvement. So to me, I think it's his model is different. And I don't know if you guys are, Morgan, you said you've spent time talking to John, so I'm sure he's expressed to you what his kind of concept is here. But he's leaving operators to be operators, and almost he's like the umbrella here. And that's a very different kind of process than, the typical tier 1 where they try to rebrand. And, if GTI buys an asset, they're likely going to rebrand it, and it's going to become Rhythm, and it's going to be, you know what I'm saying? So he's letting Deep Roots is operating as Deep Roots in Nevada, and Proper's operating as Proper, and Wholesome's operating as Wholesome. So he's not wasting time or energy or capital on trying to, rebrand these things and integrate them into Vireo. He's letting everybody be local. And I think that's a really unique strategy that's happening, but it's so far from what I can see on a trailing lens, it seems to be working. And so I suspect Easy is going to stay Easy. Like, I suspect he's going to continue this process of letting the operators be what they are, and everybody's just kind of under the umbrella.
Yeah, I do love that, calling it Easy. Ease is
Ease.
how I was doing. Yeah. it's a combo of Schwazi and ease.
I could, yeah, Schwazi, Schwazi, yeah.
Do you know where schwaz came from, Morgan? Do you know what that means?
Yeah, it's a cannabis term.
Isn't it like the trimming? Isn't it like a technique of pruning a plant or something like that?
That could be it. I forgot what it meant, but it's something about cannabis related.
Yeah.
Unique.
But do you see what I'm saying? Like, it's a very different level of integration if you are, a national footprint, 15 states, and you want everything that you acquire to kind of integrate into that versus buying a bunch of hyper local focused, single state operators, things like Deep Roots was a single state operator, and letting them be, and letting them continue. And I think they have what they gain by the partnership is they get access to obviously capital, but they also get access to kind of the corporate infrastructure, which would probably be a lot more data, a lot more resources, accounting, things like that. So I think that's where smaller businesses are going to benefit from that type of partnership, right? So it's intriguing.
The Hawthorne thing is very unique because now they have access to supply. The
JV.
Yeah,
we forgot the JV with Glasshouse.
Yeah, and now the Glasshouse JV. Yeah, which makes a lot of sense for them with Ease, how Ease is set up in California. Jesse, to your point too, from what Sammy's saying, as long as you have strong operators operating within their silos, then to your point, let them run. There's less integration risk, and now you're just centralizing the corporate overhead. And that's kind of the low hanging fruit, and then just keep going as long as you're able to keep finding those good operators that you can bring in.
Plug and play, right? And the difference in their structure of how they're doing this with equity, right, is first of all, they cleaned up the balance sheet, with equitizing the debt. So the balance sheet's in a healthy state. They got lots of cash. They have, low net debt. I think they have a relatively small UTP as well. And so,
and they just brought in more cash with the
if you're using equity on all of these like they're doing, where's the integration risk if one of them fails? It doesn't blow up the company. It's not going to break covenants, with your senior debt holders and things like that, where it's a lot more cumbersome for the highly levered MSOs, right? Where they got to get everything right, otherwise it can implode things. I mean, let's just conceptually think about True Leave with Harvest, right? How long that took to kind of course correct, right? If your worst case scenario for a Vireo, if one of these doesn't work out and you've got to cut it, is a non-cash impairment, so be it, right?
Yeah, and just to couch my comments earlier, I didn't want to sound at all bearish on the model or skeptical that they're just going out there and just doing M&A for the sake of M&A, because what they're doing is sophisticated. They're doing good deals, and the results, it's showing up in the results. Their EBITDA margins are 25% plus, which is a standout. Same store sales, I know one you love there, Sammy, 22% same store sales. It's a tough one. So it's
that's when I changed my opinion.
Yeah, so it's real growth and looks like good operations, not just bolt-on M&A. So I just want to caveat it with painting that picture, and then also I think that the independence of the operators has benefits, but I also think there's synergies that are important to realize and not miss. Which is, if you're going to go buy retail in California, generally speaking, I think just owning retail, there's exceptions, but generally speaking, is not an awesome idea. However, if you're a glass house and you have products to put through a platform like Ease or through their other dozen or so retail stores, including an MSA they have with us in our store in Palm Desert, then it makes sense because you can capture the additional verticality and push more of your products through there. So a little bit of a balancing act, I think, there, where you don't, there's the integration risk, but if you don't find some of those synergies, you're leaving something on the table.
Yeah. So far, they all seem really smart deals.
Yeah. Well, and I think they, this affords them a bit of time where they can find more of those efficiencies, those synergies, as this whole thing starts to come together more. Yeah. And to your point about what the other MSOs and maybe being slower, I know it's been tough on the private side because people want very high valuations or have had high valuations, and the MSOs are like, there's no way we can give you that valuation because this is what this is where these should transact.
We trade at 4 or 5 times. How can we pay you 7 or 8? Right.
Right. And I know that's been tough because it's like for even them to just go in and try to get more retail stores to max out their footprints and get that densification that they want in the States, it's been slow. It's been tough. And, but to your point, is like, hopefully these things will just start to accelerate again because, people are just feeling better about, their willingness to transact and seeing that there is benefit in being part of a larger, more stable organization where, sure, you're not going to get all of the upside at the outset, but
not anymore. Yeah, it's not like 2020 deals, right? Like the win no longer is going to be the M&A at the start. The win now is yards after the catch, right? And if you're a small private single state operator, pick your horse type thing. If you're a small public, right, you got to start thinking about this as a strategic option, because ultimately that's where we're headed. And if we do get the guidance from Treasury that we're getting a retroactive relief that's 9 figures for some of these companies, like the spending spree that's going to start is going to be pretty substantial, right? So
maybe to wrap on Vireo, guys, if you're a Vireo shareholder, like, I think in our audience here, we get a pretty good group of investors and operators. If you're one of the investors listening to this and you're considering Vireo exposure, I'm curious what you think, what metrics you might want to monitor. And I'll lead off here and say 2 that I would keep my eye on. One is I would look at that revenue growth number, because revenue growth is low in our industry, and it is sexy to see those triple digits revenue growth numbers. So I think that's important. However, I would complement that and make sure that the other things, further down the line, see how the EBITDA, see how the cash flow, see how the same source sales are going, to make sure that the M&A is accretive. Everyone hates that word, but make sure that they're adding value and the business isn't degrading just for the sake of revenue. And I know that we've been talking about having Vireo maybe on the show, and I think that would be an awesome conversation because I think it's a really innovative approach. I'm excited to see how it plays out. So I think look at revenue, but not just falling in love there, but make sure you have revenue growth and then pair that with things going on further down on the income statement into the cash flows is what I would be focused on. But why don't I throw it over to you, Morgan, then I'll wrap the section with you, Sammy.
Okay.
Yeah, I was just thinking because one of the things that when we're talking to people about it, because obviously like they are the talk of the town, right? They are on a trajectory that others are just not and have not been on in years. And everyone's like, well, what are they going to do with all these shares as they start to unlock? And so people have been, concerned about that. I think, and I've seen plenty of retail investors make these comments too. It was like, what happens when the shares unlock? So it's like, is maybe a question of watching the revenue growth to the share count growth. Obviously, you got to follow everything down through the bottom line, because I do care about that stuff, and I do obviously really care about balance sheets, especially in this industry. But that's one metric I might keep an eye on is revenue growth faster, or what would be the right metric to peg against share count growth versus, to measure, like, is that, and that just really comes back to this idea is how accretive is it? And obviously bottom line is the most important, but for now, as they are trying to get to a certain amount of density in these markets, I think maybe revenue growth to a share count growth.
Revenue per share. To me, on this type of hyper consolidation is the only thing that matters. Making sure that revenue per share is growing. So far from what I can see, again, what if
the revenue is dog shit, Sammy? Like, what if it doesn't translate? Like, if the revenue doesn't translate to cash flows, EBITDA, I know you hate EBITDA, if it doesn't.
But they had 54% gross margin last quarter, right? 54.4, I think, one of the highest in the space. They have a fair SG&A. There's a lot of noise in their numbers right now because of the transaction costs and so you got to kind of look past some of that stuff. The EBITDA growth is there, and the EBITDA per share growth. And again, we can't see any of these five transactions that are either closing or have closed recently. So we'll see how they all kind of integrate into the consolidated statements moving forward. But that's what I'm looking for. I'm looking for the revenue growth, the EBITDA revenue per share growth, the EBITDA per share growth, to continue on that trajectory. Also, there's two things to look at. One is, to answer your question, Morgan, is they put out a proxy last week, I want to say. So take a look at that, because it looks like a rollback is coming, and that'll kind of cue the concern about the bloated share count, right? And also giving them a share price that probably plays a lot better for institutional interest as it comes in. It's, from what I saw in the proxy, it says something like 20 to 1 to 40 to 1. There was a range, but it wasn't set yet. So take a look at that. And then the other thing was there was some board additions that were interesting in there. So look at that filing. But as the concern about the share count, I get it, and the unlocks. But if we're talking about a world where they roll back and they have 100, 200 million shares, whatever number it's going to end up being, like everybody else, and we start to see volumes pick up in the space and institutional and uplisting and access, then there's a market to absorb it, right? If there is unlocks and there is some selling. I also think they're partnering with long-term partners here. I don't think that these are privates that are just selling out, and essentially he's allowing them to continue to operate as is, right? So it's in their best interest to kind of stay on for the ride, as opposed to kind of cashing out now.
Right.
So we'll see how that plays out. But as far as what metric am I looking at, it's the revenue per share and the EBITDA per share on them. They have a high gross margin, a relatively normal SG&A, cut out the noise on all the transaction related stuff, and they have earnings per share once you kind of get into a normalized world. I don't know if I've talked to you guys about this before, but my main focus right now for this space is I mean, Morgan mentioned operating income. I take it one level lower, which is add the interest expense to that, and look at earnings before tax. We have it. We've had it for a long time. GTI, TrueLeave, TerraSend, normalized, I think, Glasshouse, and I think Vireo. There's a few. And when you start thinking about earnings before tax, which captures the interest expense of the space, you start to differentiate between the leverage on these balance sheets. Because for the most part, this space has been so burdened with that the cost of carrying the debt on the balance sheets, that if they generate a single-digit operating income, it's wiped out, and they have a loss before tax. And then this has always been ignoring 280E, and now we feel like with the news today, maybe we can start to think about ignoring 280E for a second, and that these companies will start to pay a normal business tax. So if you have earnings before tax, you're going to pay your normal 21% federal tax on that, and you're going to have earnings per share. Well, what's more investable than an industry where 60 to 70% of the weight of the ETF has earnings before tax that's going to flip to earnings per share the second that 280E is repealed? Now we have to wait for it because it's in 2 stages. But assuming we get through the hearing and we do get adult use to Schedule 3 and 280 is appealed on both medical and adult use, you have 60 to 70% of the weighting of MSOS is already going to be earnings per share, generating net income. So that starts to be an investable space. To your point, though, single digit, flat status quo revenue is not going to excite a new investor group, right? Like, we need to start also translating. Yes, we focused on the core businesses and we got the efficiencies and now we're all profitable, but now let's start growing at a 20% clip here, right? So to generate enough interest in the space that it's going to be the exciting investment sector to come. I really think that's where we're headed. I think we've gone through the hard times, but I'm a lot more optimistic than someone like Morgan. So Morgan, tell me, where are we headed?
Well, I mean, there's gonna be a ton of companies that are still not gonna make it.
No question about it.
Yeah.
But I was ruling them out. Those are the guys with either they operate at a loss, or if they have operating income, their leverage is just too punitive to the business, right? So there's erosion of equity value constantly, and that's what we saw with Air and Forefront and Graham and across the board. That's what we saw. We saw erosion of value, of equity value, as the leverage kind of chipped away at it. Yeah. And we run best in class TerraSend in 2025, 16, 17% operating margin. The industry runs at best kind of, mid 15%-ish operating margin, right? You got a cost of capital, in best case scenarios, it's double digits, and it's really hard to deliver a dollar of value to the shareholder in that world. So getting these balance sheets fixed with 280E, hopefully retroactive kind of relief, is going to be, critical for any of the ones that are on the fringe where they just don't have a business that's operating at a profit, to kind of clean that up. But again, GTI doesn't need that. We don't need that, right? There's already a handful of operators in this space that don't need a solve other than 280E to go away.
Yeah.
Like there's no other solve needed for the balance sheet.
Right.
So I think that's critical right now.
Yeah. Yeah. And I think large capital is going to look to the ones that can supercharge their growth because they're already in a position to benefit greatly for it. And, GTI were to put a plan in front of some institutional capital and says, here's our plan to grow 20% again. They probably be like, game on, let's go. Because it's going to go right to the bottom line. And, sorry for those that are not going to make it, but if you're in a position like this is a great opportunity to be looking at how can you partner up with those that would be interested, because I just think this is the time we're in this consolidation phase, potentially really getting momentum behind it. And so get ready, act, and do it if you can, because it will get harder and harder, as these markets do consolidate. Like Jesse was mentioning, here in California, we're seeing more consolidation here in California than we've seen in years. It's going to change the landscape dramatically, which should help those that can make it through, because what do we have, 500 retailers in the state, which is still just not even close to where we should be. But of the 500, people regularly quote 100 to 150 maybe that are companies that you would do business with. But if you can get more of that 500 into stronger consolidated hands, it's much better for groups like Leaf, because then there's much more end market that is operating in a positive way, in a durable way. And so I think those are the healthy benefits of going through a really tough cycle. But again, it's like for the last couple of years, everyone's just been so trying to hang on for dear life. And we talk about this a lot with, within the firm, is get back into the mode of action. What can we do now that we're here, now that we've done what we've done with this business? What are the best options from here? And for a lot of the companies, that means to sell. Some are the consolidators, but most are the ones to be sold. And
exactly, that's where we are. And I would add, because I think your point is perfect on its own, but I would just add that for those that are kind of weighing this, to really stop thinking about I need to win now. This is not a time to win right now. This is a time to consolidate, to pick your horse. If you have options to pick a horse, you may not have them, but if you do, to pick the horse, to pick the jockey that you will win with the yards after the catch, as opposed to winning now.
One thing that we haven't even talked about, though, and something we have talked about on higher exchanges before, is because Jesse's asked this question, is who's going to be the top 5 companies in the US in 5 years from now?
Yep.
And I already saw Tilray put a press release out about they're ready to get in the US. I think there's going to be a much more liquidity coming in as soon as they feel clear enough to come in. And there's going to be more exit opportunities to potentially look at with Canadian partners that were not here before. So we could have some new entrants coming in that could open up the aperture for more pathways than
with balance sheets to do it, right? If you think of Kronos and some of the operators there that can just come in and
what does Kronos have, 800 million in cash?
Yeah, something 800-900, something like that. Yeah.
Yeah, it's interesting to think too on the M&A side. If you're somebody looking to get acquired, you're looking to get the highest valuation, but you're also trying to pick the right dance partner, right, guys? Like we were talking with Leaf last year, we did a conversion of about 11 million convertible debt we had with through Canaccord, and we equitized that, and we cleaned up our balance sheet. So we just have two pieces of mortgage debt on our balance sheet now, and that's made us a lot more attractive dance partner, not just to the investor community, but if you're somebody talking about becoming part of Leaf through an acquisition, that's a lot more attractive thing to look at. And if you look at the whole range of even the top 10 companies out there, I don't want to call out names, but there's some ones in 5 through 10 that don't have nearly the strength of some of the other operators out there. And so I think on the M&A side, if you're looking to be acquired, it's about valuation, but if you're taking shares, it's also about finding the right dance partner. So if Tilray comes to the US and they want to buy, your dispensary chain and they want to do it through equity, let's say, that's a different decision than if GTI wants to buy you. You're trading into two very different companies.
100%. Yeah, big difference.
It's like with Tilray is like, I want cash. They just boom, hit the ATM, and then here's your cash. So
that's the benefit. That's the benefit for them, for sure. Maybe not for their shareholders, but
no, but for companies that want to get acquired, to your point, is like, understanding who your dance partner.
But at the same time, who would want to take a cash deal at this? At I would say today is the first inning. The first pitch was just thrown. Who would want to cash out here?
I'd take cash.
If you were an operator.
100%.
Today.
Absolutely. You can take that cash and go buy whatever company, reinvest in. If you want to invest it, you can do that. You're free to, but at least you're free to make that decision. Maybe you don't want to plow all of it back in. Maybe you only want to put 30% back in. You know what I mean? Like, if you think some of these companies, some of these operators, they've been so locked up with no liquidity for so many years.
Yeah.
And so like giving them some relief on that, is I see nothing wrong with taking cash. I know it's hard to come by, but that's why I just mentioned if like Tilray or Canopy comes down because they have the means to print cash.
Yeah.
Or Kronos can pay cash, and then you can say, turn around and buy the stock if you want to, go along for the ride, or do something, however you want to do it. But I see nothing wrong with cash.
It's an interesting take.
Do you guys want to hit C21 quick, Sammy? I've got a hard out coming up here in a little bit. Do you want to give us a quick update there? Maybe we'll disclose quick on what.
Yeah, I mean, we're continuing to do what we always do. Obviously, you guys know we paid off our senior debt. We are paying off the remainder of the debenture that we used to pay for the Deep Root store that we added last year. So that's going to end up, we pay like 4% principal a month, and that ends this year. So we essentially have no debt, right? Like that's where we're at. And so we're probably the cleanest company in the space on the public side, right? Like as far as just there, we had a lawsuit that we settled. So there's like literally no warts left. And we have 3 of the best, stores in Nevada that run at, your kind of 10 million per door clip. That's just way above the average of the space, right? Like we just outperform in every way. The state was down 15 to 17% in 25 versus 24, and we were up 15%. So it's like we're just a complete outlier on how we do things. And we have really 2 tracks here, which is to continue to do what we've been doing. We've obviously had to spend a lot of time cleaning things up and getting to where we are now. But we're also in that kind of acquisitive, let's add on stores, let's add on retail. We have, a significant cultivation there to support that and have the full vertical there. But the other option to what most of this, conversation has been in the last 20 minutes is, starting to weigh the strategic, options as well, because it's, consolidation is just ramping up so dramatically in the space. And as a clean operator, obviously, we can make sense to a lot of people. So, that's about all I can say, but, we're constantly weighing our options. And we've always said this, like, we've always had this 2-track kind of process that we were, I get asked all the time, when are you guys going to enter other markets? You guys are so good at what you do. Like, can you replicate that in another market, right? Like maybe our operation will apply to some other markets, but the likelihood of us doing it by us going out and getting a license in a new market and kind of building from the ground up versus merging, right? It's going to make a lot more sense for us to merge into new markets and apply our outlier skill set to a new market through that versus, the days of kind of building from the ground up, I think are past us. The speed of consolidation is too great now. So we will continue to do like we've always done, the best thing that we think for our shareholder. We continue to have an active NCIB. We buy back stocks. So we bought back kind of 2.5 million shares. So every instrument that we have at our fingertips to try to either protect or build shareholder value, that's what we focus on. So we're going to continue to do that. And hopefully there's, for a legacy medical operator like us being the first in Nevada, hopefully there's, some 280 retroactive relief that can really open up some options and opportunities for us, right? If there was something like that to come. So we're going to see. Until we get guidance on all of that stuff, you guys know as much as I do. So.
Yeah, that's great. Yeah, congratulations on your success. You guys have taken a very disciplined, non-splashy approach that I think is probably wise for the long term.
At least we got here.
Yeah.
Steps to winning and surviving.
Yes. Yeah. Well, cool, guys. Why don't we wrap it up talking about where we go from here? And I guess I'll start with Morgan. Morgan, at this point, why stay bullish, and what's your level of optimism around the industry going forward?
Yeah, I mean, my optimism always lies within companies and how they're performing, what they're doing, how they're taking care of their customers, how they're building their brands, right? How they're just the nuts and bolts. Because I think a lot of the other stuff is just a lot of noise. And if you just execute well, and there's companies doing, I mean, I'm very pleased with a lot of our companies, and it's great to see how they have managed through a tough environment, tough counterparties, people doing dirty, shady, illegal things, and just trying to stay focused and not getting involved in that kind of stuff, and just, trying to be focused, like Sammy was saying, like focus on the shareholders. I feel like so many have just abandoned shareholder mindfulness.
Yeah.
And a lot of companies that do, like, I'm excited about activity. As I was mentioning, I just think this is the opportune time to be accelerating that and finding paths to how you're going to do that. And because I'm very excited about the opportunity to return capital to our shareholders. Like, we've had shareholders with us for a long time, and I want to reward them for sticking through a long cycle in this industry, and making sure that our companies are well positioned to either be acquired or be the acquirers, generate liquidity, and just show that this industry is investable. I mean, we just sent out a distribution out of one of our funds today, and it's like one of our favorite days. Like, sending out distributions is a very cool thing, and after a period of very tough cycle, it's been hard to do that, and so finding ways to do that has been great. And so just kind of refreshing the cycle. I think just unlocking liquidity just will bring in so much more energy back into the space, and I think that's great from more product development and new perspective on things, and obviously getting this tax relief. I mean, we've been doing this for 12 plus years, or however long it's been. I can't even remember anymore. And just seeing what this could turn into, because I still feel like it's so early. I mean, as we were touching at the top, if this intoxicating hemp extension does not happen, which it seems like it's not, that bill got pulled. I think that was
the bar bill got pulled, right?
What's that?
The bar bill got ripped up.
Yeah. So to your point, if we're bringing in maybe not 20 billion, but if it's even 4 or 5 billion, like that is a meaningful change for this industry versus where it is today. Because that's probably what, 12-15% growth. Just
that's
moving
right.
just that.
Just
I still think that will stay out.
It's like adding an amazing new state, right?
Right.
Yeah.
Through all these existing states, which same store sales, right? And that gets people. So, I just think it's still going to be hard. I'm not trying to gloss over that, but where the good things are happening is it's cool to see. And some of our favorite guys like FlowHub, who is a sponsor of ours, I've been working with Kyle on some really interesting things, and it's like, and we were just talking about today, it's like, it's fun to do interesting things that result in action. Like, that is really cool. And like Jesse, I know, like, you guys have been doing great stuff, getting capital in, getting deals done. Like, action is what makes me excited. that's where my bullishness is. Good companies that are doing things.
I think that's where I think that's, I would say the space is investable as of today. And, yesterday, probably not, for the simple fact that there was no way to underwrite what the risk was of the growing UTP, the ever growing UTP that, just accrued ad infinitum. And that day's gonna, I know only partial today, but I really believe that today is the start of that full UTP kind of reversal. How much we see retroactively get relief on, we'll see, but I think it's going to be substantial. I think 4 to 5 billion of hemp finding its way back into the state legal market, combined with some sort of banking / credit card, organic growth, you're talking about 20-25% growth for these companies without doing anything. Right now add on kind of an active M&A strategy to start consolidating the space. To Morgan's point about action, I think the big guys got to start acting, and the time is now. The clock started. So I think we're going to start to see a pretty hyper consolidation period that we're going to enter here. And I think that's going to be exciting for everybody. It's going to be exciting for shareholders, right? I think it's time, to Morgan's point, there's a lot of even retail investors that have been in this space for 5, 6, 7 years. Maybe, they don't have liquidity. It'd be nice for them to have that. So I'm excited for that, for shareholders. And I look at today as the first step, because I don't see a world where you make medical Schedule 3, start a process for adult use to become Schedule 3, and then leave it as you still can't bank. You still don't have access to uplisting. You still don't have any custody for institutional investors. Like the dominoes that are going to follow from today's order from the DOJ, I think are the timeline is unknown, but I think the certainty around it just became a lot clearer today. So I'm very excited about what's coming.
Yeah, I think that's great, Sammy. And it's really wacky where we are right now, because the plant doesn't know if it's medical or adult use, right? And
I'll give
you can,
if you have a customer come in and they say, I've got, I suffer from migraines and this helps me, but I'm also going out Friday night and I want this beverage. Like, sorry, I got to ring you up in two different transactions here, because one's a Schedule 3 and one's a Schedule 1. Like, I don't even know how does this play out in practical terms?
Yeah, but she's even higher level than that. It's nonsensical. And so you have me, who's a quote recreational user. You have my dad, who's a medical user. If we're smoking the same flower, is that medical cannabis or is that adult use cannabis? Does it have medical value? Does it have high potential for abuse if one person uses it versus the other person uses it? So the plant is what needs to be Schedule 3, right? The plant has medical value regardless of the channel through which you push it. And so I think we're at a really clumsy, awkward period that makes no sense. So if we were to land that somehow medical is Schedule 3 and adult use remains Schedule 1, that would be just pure insanity, because it could be the same plant put into two different, same exact flower put into two different channels, but somehow you're labeling if it goes over here to this guy, it has different risk characteristics and risk profile and benefits than it does if it goes over here to this guy. So I
think we have to appreciate why that happened. Right. The reason it happened this way was they were basically, it's the UN single convention, right? Like the treaty, and really trying to avoid getting logged down by the eventual Sam, not me, Sam, but smart approaches to marijuana, lawsuit that's to come. I think they're trying to do this in a way that ensures it gets to the final, the finish line. So
it's in the Geneva Convention.
Well, I know.
Jesse made a Talladega joke before.
So I think high level, I'm optimistic about where we're going, and I hope and think the right thing to do and just the logical thing to do is to land on Schedule 3 for the whole plant. And so I'm excited about the progress that we're making. We have a little over 700 people listening live now. And I think it was the start of the show. I mentioned this story about a couple of years ago, talking to a small cap growth manager. So sorry if you're being redundant, but a lot of new listeners saying, Jesse, how can I play the game if I don't know the rules? And Am I partially disappointed today that we don't have the full rule set? Yes. Am I grateful to see the continued progress? Right. Today wasn't bad news. Nothing bad happened today. It's just taking it a step at a time. And even though we're used to this in cannabis, it never feels good. But I think in terms of my level of optimism, it's higher because we're continuing to take the right steps. We're starting the hearing in a couple of months. And hopefully in Q3, we can have medical cannabis and adult use cannabis, playing under the same unified rules of Schedule 3. So I think as an industry, it's a huge step forward. I think for people, humanity, patients, it's a huge step forward. Anything that allows more truth, more access to cannabis, and allows more people to be helped, that's what gets me most excited. And then we have the financial benefits that go along with that, which are obviously key as well. So I love that we are starting to get the rules, and cannabis today is more investable than it was yesterday. And I think that's a huge step forward. The second thing I'll say is I'm glad we did deep dives on these companies today, because I think that's what you guys need to be doing out there. Like if you want to buy the basket and buy MSOS, very liquid, if you like the tier 1 exposure, that's great. There's some awesome companies in there. But I think this is an alpha generating period where you can beat benchmarks by picking the right companies. We don't have proper cannabis benchmarks, but you see where I'm going. And so look at the companies we talked about today. Look at the GTIs, look at the Vireos, look at the C21s, have a look at Leaf. They're all really different options, guys. Leaf, small, fastly growing, huge market, focused on concentrates. Sammy in Nevada, real sound fundamentally, awesome stores, a lot of optionality there. Vireo, the roll-up model, startling revenue growth, and kind of the new kid on the block that's killing it. Then you have old reliable, best-in-class GTI.
Old faithful.
Old reliable, best-in-class GTI. That continues to be rightfully so the bellwether of the industry. Then you can go deeper and look at Cureleaf if you want to look at international exposure. So I think as an investor, it's exciting. I would be leaning in more as an investor, but I'd be doing more work than ever to figure out where do you want to place those bets. A little bit over here in California, a little bit over there with Sammy in Nevada, a little bit over on the Vireo side for the roll up. Get some real class with GTI. You want the international, go with Cureleaf. There's a whole bunch of different ways to play this, but I think digging in is more important than ever. So I'm excited about the opportunity for stock pickers out there. But I've had mixed emotions today, guys, because we always want all of it at once. But I think overall, I feel like today was a massive step for the industry, and I'm grateful for it.
Well, and I'm sad that you had to qualify that today was a good day, that nothing bad happened, because I can assure you that if the stocks were up 20% today instead of down 20% today, everybody would have claimed that today's news was fantastic, right? And this is the whole problem with narrative, price and narrative, right? Narrative is so shaped by price in this space. I know it is in general in the markets, but in this space especially. And the problem with allowing the narrative to be shaped by price is you're allowing a very inefficient, I'll call it deficient market, to determine what the narrative is.
Yeah.
And I think that's where we have to, draw a line and make it clear that, today's news is a fundamental change, a fundamental beneficial change, the greatest one that's ever happened for this industry. And whether the markets can appreciate why that is today, or it's going to take time as we get clarity on what it means, and as we get clarity on the hearing and where adult use ends up landing, so be it. Some would say it's an opportunity, and I know nobody wants to hear it because we've been saying there's been opportunity at every flush along the way for the last 5 years, and nobody has any money left to make it an opportunity of the existing shareholders anyways. So I guess it's an opportunity for new shareholders that are now tuning in, right?
Absolutely. And I'll close with a quote from Mark Yusko, an investor I really like. He built the UNC endowment. I think he was at Notre Dame for a while, and now runs a firm called Morgan Creek, which is awesome. And Mark said on Twitter on October 31st, 2025, I always remember that the price at which two investors choose to exchange a small amount of an asset is not the value of the asset. Price is a liar. And I think about that all the time in cannabis, especially with some of the smaller stocks out there. And so do the work fundamentally. Think about it with your own perspective, and don't get too hung up on the day-to-day. So with that, guys, let's finish it up by thanking FlowHub for making today's show possible. I'm going to make this simple today. I had a dispensary. I put together our own software with duct tape and bungee cords. It was a nightmare. It was terrible. Don't be like me. If you have a dispensary, don't be like Jesse. Use the best, go to flowhub.com, schedule a demo today, and upgrade your software. So with that, guys, I felt like that was a good show. Kind of feel like I need to have a drink or take a shower, even though I haven't had a drink in 6 months. Whew, covered a lot there.
Yeah.
We did, and we barely scratched the surface, unfortunately, but
I know. I feel like we could have talked for an hour about Schedule 3. It's the curse of the higher exchanges agenda. We never get through it. But yeah, that's Sammy. I know you're a busy guy, an operator as well as an investor, and I appreciate that you take the time to put yourself out there on X. I know it's additional work that you do with your free time, kind of like me.
Yeah.
And appreciate you taking 90 minutes to chat with us today. So thanks for coming back on.
Thanks for having me, guys. I look forward to next time for sure, and hopefully we have a lot more to talk about next time. Sounds
good, my friend. Morgan, always good to talk to you, and we'll see you guys back here in about 2 weeks. The views expressed in this podcast are provided for informational purposes only. Nothing we said should be considered research nor a recommendation. All investing involves risk. You know this because you invest in cannabis, including the loss of principal.